Hi, welcome to Shri Management channel. In case if you are a freelancer or someone who is self-employed, this video is for you. So we are going to see in this how a freelancing consultant or self-employed can claim house rent allowance. Yeah, generally HRA is not allowed to be claimed by someone who is not receiving HRA component as part of their salary. So this section 80GG, allows the freelancers, self-employed people who are not receiving HRA as part of their salary to claim deductions under this section. Let's explore what are the eligibility conditions these guys has to fulfill before they claim this deduction, and also let's see what exactly is the calculations involved behind it. So the eligibility condition to claim deduction under Section 80GG are either you are self-employed or salaried. So in case of self-employed, I'm talking about freelance consultants. In case if you are serving your clients, getting fees and working as a freelancer, then you are self-employed. And in case of certain salaried employees as well, they can claim this deduction. I will come to that in a minute. So you should opt to pay tax under the old tax regime. That means that currently we are following the new tax regime or the default tax regime, which is applicable for Section 115 BAC1A. So in case if you want to claim deduction under this Section 80GG, you have to be opting for the old tax regime. And most important is you should not have received HRA at any time during the year for which you are claiming. And that means in case if you are a salaried employee, though you are getting a recurring monthly salary from your employer, the salary should not have a HRA component officially. Even then, being a salaried employee, you can claim this deduction. And you need to require to file Form 10BA. I have created a separate video how to fill Form 10BA and what are the details that goes into that. Do look at that video. I will provide the link of that in the description below. At a high level, it captures the property details where you are currently staying and claiming the rental deduction. And also it captures a self-declaration from you that has to be filled along with the ITR declaration. And when you are filling the Form 10BA, in case if the rental amount exceeds 1 lakh per annum, then you need to file the PAN card of the land owner as well. There are few other important points, so pay a deep attention to this. In case if you or your spouse or your minor child or the Hindu undivided family of which you are a member uh, do not own here. So if you see here, they should not own any residential accommodation at the place where you are currently residing, performing duties or employment or business or profession. That means in case if you or your spouse or your minor child owns any residential accommodation at the same place where you are claiming the rental deduction, then you are not eligible to claim this deduction under 80GG. That's point number important to remember. And second important thing is that in case if you own any residential property other than the place mentioned above, you should not claim the benefit of that property as self-occupied. So let me explain. In case if you're working in Bangalore as a self-employed consultant and if you own a residential property at say your native place in Delhi, then you should not claim the benefit of that property as self-occupied. That property, whichever is in Delhi, is deemed to be let out. That means it is not considered as like self-occupied property. The most important thing is to understand how to claim deductions under Section 80GG. Here it is the least of the following will be exempted from tax. So you have to arrive at a calculation and then see which among these three components is least for you. Either it is 5,000 rupees per month or 25% of the adjusted income, or the actual rent paid. That means let's say you are paying 20,000 rupees rent, then 20,000 multiplied by 12 will be the rent paid for the annual year, and that should be an actual rent less than 10% of the adjusted income. Then calculate the amount and see which among these three is the lesser one that should be picked up for deduction calculations. The adjusted income calculation is pretty straightforward. This is total income minus long-term gains you are having, and then short-term capital gains, and then any other income you are receiving under 115A or 115D. or any other deductions, let's say towards your insurance policies or any other deductions under starting 80C to 80U, any deductions, whatever you are doing. So minus that from the total income, except for, of course, the section 80GG, and see how much you arrived at the adjusted income that you can use as part of this calculation. That completes how do you calculate and arrive at the tax deduction for section 80GG. And when use this deduction amount calculation while filing the income tax return, and that will help you to get necessary deductions from your total income and help you to save some taxes. Hope this was quite helpful to you. In case if you like this video, do hit a like button and subscribe. Thank you so much.